Good morning, everyone. Hope everyone's having a great week so far. It's me, Markets and Mayhem, and it is time to start another episode of Back to the Futures. We're going to look at order flow analysis for stocks and futures. So be sure to bring some chart requests, some questions, anything you'd like me to look at during today's stream. Drop it in the chat, and I will do my best to get to you. Sometimes the questions get a little bit popular, so queue up early on if you have any to make sure that I can get to them. And thank you for tuning in. I'm here every Tuesday at 9 a.m. doing this stream, 9 a.m. Eastern. So be sure to join up. It's a lot of fun, and I enjoy doing it. I really enjoy the opportunity to share what I'm looking at, to interact with my audience, and to look at some of these cool trading tools and setups. Now, the folks at Bookmap would love for you to join them on their Discord. They got a lot of cool real-time educational events and just really a great community of people as well. If you're using the product, you have a question, if you don't know where to go, this is a great place to start. And speaking of education, there's also a new course that the Bookmap team has put out recently called Supply and Demand Setups. Give that a shot. You can check it out using the Bookmap Learning Center. And a little bit about me, I've been at this game for a while. It was about 20 years trading markets, and it's been an amazing journey. And one of the things that inspired me to do what I'm doing now is early on in my journey trading, I was fortunate enough to have some really solid mentors. They gave me a lot of help kind of pulling forward my experience level so that I was able to avoid some of the pitfalls, obviously not all. Everyone has ups and downs in trading, but it helped me to fast track and move forward with a set of knowledge that I want to pay forward into today. That is to say, one of the reasons that I'm so generous on social media with the information I share, and one of the reasons I founded TraderAid as well to bring that to the next level, is to help traders of all skill levels accelerate their journey, navigate through, and even get through a lot of those initial pitfalls to find consistency, to learn more about themselves so they can learn more about how best they can trade. And one of the things that I like to often say to folks is, if you are looking for trading to make you rich, it may happen in the long run, but in the near term, it's best to get it down. Have a system that you understand why you're taking trades, when you're taking trades, what kind of size you're putting on. And that system needs to be something where you understand the results over time, where you understand why trades are winners and losers, so you can start to build some repeatability out of that system. It doesn't mean you're ever going to have a 100% hit rate. No one will, really. But it does mean you can put the probabilities on your side to have more winners than losers and build that business over time. And yes, I call trading a business. It is a business. As traders, we are buying and selling inventory, hoping to repeatedly capture a positive spread. That is really it in a nutshell. We could take away the lottos, the Lambos, all the, glamorization of it. Trading is a business, and you have to have the discipline to run it like a business so that you can keep your doors open next day, next week, next month, next year. That means proper sizing of your positions. That means not full port FOMOing into anything. That means making sure you have those cash reserves and also a system that helps to navigate you through your trading process. Now, I began working with Bookmap in early 2022 because I saw a lot of value in the way their platform displays data, particularly for day traders. I think this is an invaluable resource for ETF traders, for stock traders, for futures traders, to be able to see the liquidity and to be able to layer on some of the other tools. So let's talk a little bit about that, why I watch order flow. Well, one of the biggest components of order flow analysis is the deltas, right? And that's the differentials between buying and selling. And it can be within a specific instance of time. As you can see in the background a little bit, there's those bubbles. We'll talk about them more when we get into Bookmap shortly. But that's part of it, those delta bubbles, right? The other part of it is looking at things like the session volume profile. And you can see where those aggression marks are from buyers in excess of sellers and vice versa. This can give us a sense as to both who's in control at particular price levels and also, if we see a lot of aggression and someone's getting off sides, where there might be motivation to get out of those positions. For example, if you see a huge buy delta and it's getting further and further overhead as the market goes lower, a lot of those buyers are likely to become motivated sellers as price gets further away from them. So that's one reason this is helpful. Another area I like to look at, icebergs, looking for those large passive order flow footprints, typically from some of the larger desks. And I tune up my icebergs specifically to filter out a lot of the smaller size and really focus on those bigger moves, the ones that could potentially move the market. And we'll talk about that a little bit once we get into Bookmap. And then finally, exhaustive trading action, where one party gets off sides, right? So if we look at a situation where someone's just sweeping the book, they're getting super aggressive, they're throwing tons of volume at it, and maybe they're not getting a lot out of it, you can start to see some signs of exhaustion. I've actually built an indicator that identifies exhaustion algorithmically inside of Bookmap. And that's something that helps me to find these events where you might be able to capitalize on a potential intraday reversal as well due to that exhaustion. Now let's take a look at a couple of charts here. First is NVIDIA. This is a weekly chart of NVIDIA, and below you can see it did honor this trend line, which goes back a ways in that most recent hit, that drawdown in April, where it broke below $90. And remember, recently, before all this played out, I guess it's not as recently anymore, but I did talk about eyeing $90 or so as a potential price target for NVIDIA. We did get there and a little bit below, and I think for now, we're out of the woods momentarily. We're caught in the Ichimoku cloud. That means we're trendless. You can see the MACD histogram below. So we're in the cloud here. You can see the histogram below. Still pretty nasty negative momentum overall. But you can also see we've kept this trend line. And we're still in a larger high volume node in the volume profile. So what that tells you is we're likely to consolidate here. I would be more bullish on NVIDIA if we could break above the cloud and the 21-week moving average. I think then we get some pretty nice continuation here. You could see that almost looking like a bit of a bull flag if it broke out like that. On the other side, however, if we break below the cloud and this trend line, I think we're going to see some pretty nasty new lows in short order. So for me, I'm looking at NVIDIA right now as it's in its decision zone as it approaches earnings. We've got a lot of mega cap earnings coming up this week, by the way, about 40% of S&P market capitalization reporting this week. NVIDIA not among them. They'll be coming up later. But this is one that can move in sympathy depending on some of the CapEx plans we hear from companies like Microsoft or Meta, and Amazon. Then we have Apple. Apple has recaptured its recent uptrend, and it's starting to look a little bit more healthy. This is, again, a weekly chart. And we are now approaching an area of supply. This is an area that's likely to be resistance. It has been during this whole chaotic movement. Add to it, we are in the Ichimoku cloud, so that means we're trendless per that way of looking at the market. And we do still see some pretty chunky negative momentum in the MACD histogram. So I'd say with Apple, we're not out of the woods yet, but I would be a lot more concerned about the stock if we break below 200 and we break below this trend line in the cloud again. At that point, I think we get fresh lows below that most recent low, probably around 160. On the other side of it, breaking above the cloud and the 21-week moving average likely puts us on a track to retest 240 to 250. So Apple also sort of in its decision zone. Earnings could be consequential for this one. And gold finally consolidating. Can you believe it? So we've had now basically 2 weeks and a trading day where we've been trading in this zone. We had a false breakout last week, but we didn't retrace too meaningfully. So I think we're still in this sort of sideways consolidation. You recall last week I was saying I really would like to see gold pull back and consolidate because it's just getting a little bit feverish in this parabolic move. I hate parabolic moves in gold. I've been trading gold since 2006, and I can't remember looking at charts that go way back before even then, any parabolic moves that ended well. So seeing this consolidation here gives me some hope that maybe we can spend some time moving sideways before grinding higher. That would help to improve the market structure of this trend. And for gold, I am a buyer on retests of that 21-week moving average. We can see how reliable of a momentum indicator it's been. Obviously, if we close below it on the week, I'm no longer interested in that trade. But for now, that's where I'm looking for a pullback to about the 21-week with a bit of a bounce to want to get long gold. I do have a runner position on in gold. I took off my core, and most of that core went into silver and gold miners, one of which is Rio 2 or Rio.V on the Toronto and Rio FF on the OTC. That thing's been flying. So I don't have any regrets getting out of gold because I was able to capitalize even more on how some of these other assets are performing. But I'm still interested in getting back in if we can get back to that 21-week EMA and structure is still in an uptrend. And the S&P 500 is closing in on a major area of supply. So I would be looking at especially 5550 and 5600 as areas where we're likely to see some pretty significant resistance. I also think folks that were kind of riding this whole tumult and then are able to get out just break even are likely to add to that supply. That is to say, folks that were buying in these areas hoping, oh, this is the low. Okay, cool. And then they got absolutely smashed. If these folks didn't get kicked out from stops, if they were non-leveraged and they had a high pain tolerance, they're probably just looking for this to get back to even. There's a weird pattern in the psychology of trading where folks that have been beaten down on positions, they're done with even trying to look for a gain. They just want to get out break even. And I think you could see some of that add to the supply here on SPX. So we are getting into a pretty chunky, crucial area. And you can see pre-market, we are pulling back as well. So we'll look at that on the charts when I go through the Bookmap live. But pre-market, we are seeing a bit of a pullback recently. And we do have a large call wall overhead. We had initially broken above it pre-market. We can see now it's acting as resistance and really rejected price down to Gamma 1. And that's going to be the SPX 5500 level. And again, we'll look at those charts live in just a few. Here is something you might want to screenshot. These are some SPX options visualizers for today. These are some of the levels that I'm watching. And I'm going to just put this out on social as well. And then looking at this in context, you can see we're pretty darn close to that gamma flip neutrality. I'm just going back to these charts from before. So we are no longer deep in negative gamma. That should help to reduce some of the insanity of the moves that we see intraday. It kind of reduces that chase dynamics. That chase dynamic is where dealers are more likely to sell dips and buy rips, and that exacerbates intraday volatility. This should help to kind of pacify that a bit. But on the other side of it, we continue to be in an environment of very low liquidity. And that's a problem because that does add to the potential for a smaller amount of order flow, creating a much bigger impact in price. Now, today's intraday pivots, these are the levels that I'm watching. It's going to be S&P 500 futures June contract 55, 55, 50. And NQ 19, 5, 27, 50. And the reason I'm looking at those levels is this is based off of looking at transactional activity over longer time frames and finding areas that can act as decision points for the market. And we could see this morning that 55, 55, 50 level on ES was a decision point, and it rejected there pretty cleanly. Now, just in a moment, I'm going to get into Bookmap Live, but I wanted to share two promotions with you real quick. And you can bookmark these for later if you'd like. We've got some really cool exclusive deals going on, one of which is for Bookmap. You can get up to 40% off of Bookmap using the code. Actually, you don't even need a code. Just visit traderaid.com/bookmap. Scroll down to the special offers, and you can get up to 40% off, which is a pretty chunky discount. Then, if you'd like to check out TraderAid right now, get up to 20% off traderaid.com using the code Mayhem20 at checkout. You can check out what we're doing, some of our exclusive trading tools, including the SPX options visualizer, our pivots, our live options flow and alerts, and our news squawk, as well as our ideas and analysis, and of course, our amazing community. So we're going to switch over to Bookmap here. Give me one moment. All right, folks, we're going to take a look around the markets. And again, if you all have any questions or chart requests or otherwise that you'd like me to look at, let me know. We've got gold on screen here, so we're going to start there. And overnight, not a whole lot of action in gold. Looks like it's going to come in down about 0.8%. Silver's up about 0.4%. So kind of a choppy to downward trading session in gold overnight, as you can see. And silver, kind of the opposite look. Isn't that interesting? Silver kind of giving us a feeling that it might have a little bit of juice here. And I like silver for one key reason. I think China is going to finally do what they've been talking about for so long. I think they're finally going to stimulate their domestic economy. And I think in doing so, they're going to bring about some pretty powerful animal spirits, things like silver and copper, which is in a pretty decent amount of deficit. So that should be bullish for the metals, the industrial metals. Gold, on the other hand, has some room to consolidate. The gold to silver ratio also suggests silver's pretty darn cheap here. So I'm liking silver a lot. I think for the trading environment today, we could still get an additional push higher here. You see some interest developing just around 33.80. And this is a pretty thin trader, only 4K contract book depth on this thing. So when you see 100 on the offer, that is actually a reasonably chunky offer for this thing in relative size. Now, let me just take a look here. All right, we're going to pull up the S&P 500 chart just to see some of that price action. We're plunging now to new pre-market lows. We just got about 13 minutes left until the open here. And we could see that rejection at the call wall. That also has now become the point of control. So that is an area that's become even more important than it was previously, given that confluence. Sellers pulling down the point of control. And in terms of today's data, it is a heavy book. We've got JOLTS at, JOLTS has come, let's see, JOLTS is coming out at 10, CB Consumer Confidence coming out at 10. So those are going to be two big ones that we need to watch very carefully. JOLTS prior reading 7.568 million. Forecast for today is 4 million. Consensus is 7.48 million. Market would probably like to see that a bit lower. That could help to bring down rates. That could juice equities a bit because it gives a higher probability that the Fed's going to cut, and that's something the market really wants to see. So I'd say JOLTS at 7.2 or below bullish, JOLTS at 7.6 or above bearish. Forecast 7.4. Then we also have Conference Board Consumer Confidence. That is supposed to be coming in around 89. That's the forecast. Consensus 87.5. Prior reading 92.9. I think that the market would like to see some higher confidence, but I don't think it's going to get what it wants. We'll have to see how this data point goes. I'll be watching JOLTS much more carefully, and I'll stay on the stream just a little bit after 10 so we can parse the data and talk a little bit about what it might mean for the rest of the trading day. But overall, we can see pressure mounting in the S&P 500 futures ahead of the trading day. And let's talk a little bit about what's on screen before the market opens. So this is our heat map on Bookmap. We're going to zoom into just a 20-minute time frame. You can do this with the time slices button up here. And we can see these iceberg icons. These red diamonds are iceberg icons. And icebergs are when you have a large amount of passive selling. At least that's how I'm identifying them, because I have them set up so that it's only the largest iceberg orders that are going to show up. So this is a chunky order for pre-market, right? You see that once we started to just see a little bit more buying interest come back, sellers did start to iceberg into those larger green bubbles, those larger delta bubbles, showing that buyers were showing some interest here at the lows. And sellers are basically saying, you know what, you may want to keep your expectations in check. We still have some supply here. You can also see on the session volume profile, that's the SVP column right here, there is some pretty chunky buy deltas up here and even bigger sell deltas just around the point of control. Gives us a sense as to who might feel some discomfort at different levels. Those buyers from earlier, they're feeling some of that discomfort. Those sellers in this area, they're all in the money. They're happy. So we'll be watching that session volume profile throughout the trading day as well. Then we also have the current order book. And this is very simply just your depth of market showing up in a new, more innovative format, because it also colors the heat map based on the depth of liquidity. Now we can see there's this bracket of algorithmic liquidity that the market makers have been using. Really, this has been a phenomenon since July of 2024. It only used to happen around contract rolls. Now it's kind of been all the time. Fortunately, there is a feature in Bookmap called TradeMap Pro that allows you to filter that out. So you can see using this feature, we've gotten rid of that bracket of liquidity using TradeMap Pro or TraderMap Pro. And that's right here, TraderMap Pro. I'm using the Pro plugin. You can use the Lite plugin if you're not layering in any additional advanced features. But it allows you to very simply just set your sensitivity level and then filter out that liquidity algorithm, which can help because it clears up that current order book. You can see a little bit more clearly where the real bids and offers are versus that market maker bracket of liquidity. Now this yellow line here, this is the point of control. That's where the majority of transacting has happened over the session. This green line below, this is the lowest price. You'll also have a red line above showing the highest price. That resets at 9:30 a.m. to make it easier for me to track highs, lows, and the opening range. And that's a very easy to use plugin that you can add in as well. And it's just called price levels. And I disable the middle price level. I just have the highest price level, lowest price level, and the reset every day at 9:30 a.m. Eastern. Another thing I recommend using, if you're using Bookmap, because you probably see me on Twitter, I talk about the order book depth. I talk about, the market not being liquid because, boy, has it not been liquid at all lately. It's been super illiquid, dangerously illiquid. If anything big was to happen, this market could move 5-6% in a matter of minutes in either direction. Pre-market, we're looking at an order book depth of just under 20K. You can add the offers with the bids to get that. And you can set this up easily by using the outside liquidity plugin on your copy of Bookmap. So you can immediately judge your market depth. And then from there, you can get a better idea as to whether you want to, reduce your size. Yep. So someone just asked me, I just noticed that someone asked me. So it's actually like kind of psychic because I didn't see this question from you. But nevertheless, I'm addressing it right now. So this is how you do exactly what I was talking about. And yeah, it's just, some telepathic communication we got going on, right? But yeah, you just use the outside liquidity plugin. I tell it to show the liquidity and the difference, and then I include the visible price levels. Okay, so that's giving you the whole order book. Y'all are very kind. Thank you. And so that way, you can at a glance, you can see this for futures, you can see it for ETFs, you can see it for stocks. But the other cool thing about this is it also tells you the delta. So right now it's showing you that there's that delta here, and you can see that delta on various other books as well. So it's going to show you right here, there's a delta towards the offer on S&P by about 148 contracts. On crude, there's a delta towards the bid by about 200 some contracts. So this is all kind of neat as well, just being able to show you what's going on. I misspoke. It's the delta towards the bid on S&P by about 188 contracts. It's inconsequential delta. But if you see one side getting way more aggressive on the amount that's in the book, that can give you another bit of clue as well. For example, if you saw the supply side on this at 50% in excess on the demand side, that gives you a sense there's a lot of supply. Then the next question is how close is it to price? And you can start to look at the current order book to figure that out if that's a condition. Today, you can also see there's a larger offer at 5650 overhead, about 360 contracts there, another 247 contracts at 5600 ES. So there is some chunky interest above price. And then below price, we also have a pretty large bid at 5,500 with 200 contracts on bid. All right, got a couple of questions coming in, and I'm going to answer those as we are just about 5 minutes away from the market open. Give me one moment. All right, I've got one question coming in from Extreme Skeletor, and I was a He-Man fan as a kid, so that's awesome. Great name. Do you think it's better to hold silver futures contracts or an ETF to capitalize on the low silver prices? Well, I think that's a good question. I'm going to say there's more answers than the two that you've offered me. So, personally, first of all, I will say I prefer futures. I prefer futures for several reasons. One, I prefer futures because my stop can be triggered during extended hours where an ETF is not going to be nearly as liquid if it's trading at all. So that's point one. And there's multiple size silver futures contracts. So you don't have to get too intimidated trading the Big Daddy contract. There are much smaller contracts to trade. Second, futures have better tax treatment. If you're in the United States, you get that 60/40 tax treatment. Third, there's no wash sale restriction on futures. So you get those three big bonuses: greater availability, better tax treatment overall, in two different areas. But I would say outside of futures, I also think it's really important to consider whether or not it makes sense for one's investment strategy to have some physical as well. Personally, I do like having a little bit of physical precious metals for a longer term hold period. Like, and this is going to date me, but I was buying silver in the high single digits in physical way back when. And obviously that's done okay. But that's an area where I think if one is looking at this as a longer term hedge or insurance policy without counterparty risk, having some precious metals in the safe or in the bank deposit box or whatever isn't a bad idea. Then there's also the idea of some of the silver miners. There are silver miner ETFs. The junior miners tend to exaggerate the beta quite a bit, and then the senior miners, they tend to outperform the metal during a good bull run. I think these are worth looking at, but I would be very cautious and say either only choose very well run, high quality companies or the ETFs as a investment or as a trading vehicle. I wouldn't necessarily just willy-nilly go out there and look at some of the whole mining space. There's a lot of trash out there. All right, so follow-up question. So you compare relative book depth, not really on a metric, but based on what you've seen in past historical. Okay, so this is a great question. And let me say, first of all, there's a tool called CME Quick Strike. They leave off the C for savings or something, but it's CME Quick Strike, QUIK Strike. You can look at their liquidity tool, and you can pull up historical periods on all the futures contracts that trade on CME. So you can see the liquidity from a historic time frame. That's a great starting point to kind of get your roots into monitoring relative liquidity levels. For me, I've been trading S&P long enough that I have a sort of feel for it. It's almost like if you go to the beach and there's high tide and low tide. This is low tide. And you can feel it. Like when the S&P futures contract is liquid, it's got 55, 60K. This 20K nonsense is insane. Like, this is so illiquid. It's like you see now, not because of necessarily higher volume, but because of a lack of book depth in the futures, that ETFs are making a larger part of the tape now in the market versus futures. And this has a lot to do with just this sort of collective pulling back. There's just not as much participation in the futures market. And a lot of this happened as volatility just went crazy. I think some folks were basically told by risk managers, you've got to pull back. Some shops probably stopped trading these futures contracts entirely and maybe shifted risk management to options and ETFs or otherwise. But at the end of the day, this has changed the market. This is a market where it takes a lot less volume to move the book more. And markets, speaking of them, they are open now. And I'm just going to take a quick look here. I'm going to bring up something to show you a different view. Okay. So we see the view on Bookmap. I'm also just going to show, this is the SPX options visualizer shown through Motive Wave. And the reason I'm showing this is just to give you a sense as to how clean some of these pivot and options levels can be. So you can see we had that rejection at the call wall earlier, right? That was pre-market. That was a pretty solid rejection from basically 6:30 on. We just kept trying that level and kept getting rejected. Now we've fallen all the way to Gamma 1. That was yesterday's most active put strike, whereas the call wall was around yesterday's most active call strike. So these options implied levels, obviously converted to futures, can be pretty actionable and pretty important levels to watch. Now, my daily pivot, as you can see up here, is 55, 55, 50. You can also see that was a relatively decisive level. This is also just around the gamma flip level as well. Got a lot of confluence up there. I think this market's going to want to go back up and test this another time during regular trading hours. That's just the sense I get. Let's see how the flow takes shape in the opening range. But I get this sense there's unfinished business up there. And the more we knock on that level, the more likely it is that we break through. So I just wanted to pull that up real quick and show you all. All right, so we've got some other questions coming in. Just give me a second. I'm parsing these. Jay Global asks Iceberg. Jay, I guess you're asking, are you asking what is an iceberg, or is that an iceberg on screen? If you're asking what is an iceberg, because I'm sure there's folks listening that don't necessarily understand the dynamics behind these, an iceberg is a large passive order where you're hiding the total size. So let's say I have to move 2,000 contracts of S&P futures. Obviously, if I put an order on the book that's 2,000 in size, that's going to freak people out a bit. That's a pretty large order. Like if we zoom out the book right now, you don't see any orders of that size anywhere nearby, right? Or anywhere at all. So what does that tell you? It tells you that you're going to probably want to reduce the size you're showing. In order to do that, you put on an iceberg order. The whole point of an iceberg is to try to reduce the impact that your order has on price. So it means you're a little more patient getting that order out there. And it's also beneficial because you're trying to disguise the total size of that order. So that 2,000 contracts that I want to move, let's say that I wanted to move it at 55.50, okay? I would put it in at like 100 order, 100 size on offer. That means my iceberg has to hit 20 times to be full, but it also means it's small enough that it's not going to freak folks out thinking there's so much supply up there they won't be able to get through it. So you can kind of look at icebergs as almost like being at a game of poker. You're not necessarily showing your hand. When you see really, really large iceberg order flow that becomes too large to ignore, thousands and thousands of icebergs, that's when it can, however, have an impact on price. So let me know if that is helpful. June H asks, the 9.7K on top and the 10K in green letters at the bottom, are they the number of orders? Yes, exactly. So on top, you've got the number of offers. On bottom, you've got the number of bids. And then to the right of the bids, you've got the delta, which right now favors bids by about 500 contracts. So let me know if that helps, June. And if you're in Bookmap, you can do this too. You just want to use the outside liquidity tool, show the liquidity and the difference, and include the visible price levels, leaving everything else unchecked. Good morning to you, Pippin. And Pippin asks, is the iceberg available for all brokers? That is a really good question. And I'm assuming that you're asking about you placing an order rather than watching other people's orders, because we're kind of talking about, in the scenario, how we might see it, but also how it may be operated if I was the desk, right? So we kind of looked at it from both sides, the person doing the order versus the person seeing the order. So in this scenario, I'm assuming that you're saying you want to make an iceberg order happen. A lot of brokers do support them that are more geared towards traders. So for example, I use interactive brokers for a lot of my trading. And in interactive brokers, they have all kinds of different order types and routing and different ways that you can optimize depending on what your goals are. And you can absolutely use icebergs there on stocks, on ETFs, on futures, on pretty much any trading vehicle. I believe you could even use them on options if you're moving enough size and it makes sense. So let me know if that helps. This is a broker specific question, so I would check with your broker. But it's always a good sign when a broker is offering their client a whole bunch of helpful order types so that the client has different ways to move around the market. If the only thing you're getting are stops, limits, and market, that's pretty bare bones. That's not bad for an investor if your holding period is a long time, but for a trader, it's not great. Also, if you're an investor and you have a larger portfolio, let's say you're moving 8, 9 digits and you have orders that are in the six figures and up, you probably want icebergs for that too. Because again, unless you're moving in something really, really liquid like NVIDIA or Tesla, if you're using any kind of mid cap or small cap stocks or less liquid futures, you're going to make a footprint. And you don't necessarily want to make that footprint. It can, kind of work against the best execution and price discovery on your behalf. Night Fox says why most people choose not to trade in the first 5 to 15 minutes of the opening. Yeah, it can be pretty volatile and violent. So the two most active time periods of the day are the first half hour and the last half hour of trading. There's a lot of theory built off the first half hour or first 20 minutes or first 15 minutes or even periods as short as 30 seconds called the opening range. And people will look at the high and the low of those varying time periods and then how price interacts with them. Whether you get a breakout of the range and you build acceptance or a break below the range, or you get one of these even more interesting days like a double break day, which by the way, Tuesdays are more likely to be double break days based on the last 5 years of data. That means you have a breakout and a breakdown or vice versa out of that opening range. And that specific statistic is for the 30-minute opening range, but it seems to ring true for the 15 and 20 as well. So we are coming up on JOLTS, folks. JOLTS orders are going to be coming in at 10 a.m. Forecast is 7.4 million. Consensus is 7.48 million. And previous reading of 7.568 million. And this is a market that is showing some signs of being overbought. So it is something to be concerned about that we could start to lose steam here, especially if we have any negative catalyst. If we look at things like the NASDAQ McClellan oscillator or the number of stocks above their 20-day moving average for the New York Stock Exchange, we're getting into territory that is a little bit exhaustive to the buy side. It doesn't mean that it's like a top or that the market has to immediately retrace, but it does mean that this recent move has been so much so fast that you have a higher probability of consolidation or correction. It's all about probabilities. Trading is just a probabilities game. And I will say, folks that pretend they can predict this and that with any level of accuracy, there's not a lot to that. And a lot of the time, those folks are deleting the tweets or whatever predictions didn't go well. It's much more of just a probabilities game. Honestly, like if you play it from that perspective and you stay humble and you realize you're just trying to trade the tape in front of you, you can do a lot better at this. Don't make it an exercise of ego. Don't look to call the absolute bottom or the absolute top. There's no point in that. The goal of trading is capturing the momentum consistently. Buying and selling inventory, capturing that spread consistently. So if you captured the bulk of the move more often than not in your trades, then you're winning. If you're kicking yourself because you didn't get out at the absolute top or you didn't get in at the absolute bottom, forget about all that nonsense. That's just noise. And in fact, trying to trade that way will hurt you more than it will help you. June says the delta is positive, which means more buys than sells, but price action still goes down. So I would say with that, we do have some reasonable distribution. There are sellers kind of leaning in here. We'll see if we get any absorption events, but this is also a very thin tape. Even with the market open, we're just at 21K order book depth. Not what I like to see. And we see a bit of a stop run playing out here. You can see those 616 stop contracts in the S&P 500 futures triggering on this move higher. These are shorts that are getting pushed out with market stop orders triggering. And you can see that pretty large buy delta candle down there as well. Point of control was pulled lower, but now we're starting to make a break above. And let me just pull this back 1 second. Let me show you another area we're watching here. Here are the pivots. This 55, 45, 25, we're going to be watching that pivot level. I think if we can break above it, we've got a really good chance at targeting this confluence zone again during regular trading hours. Pre-market, we've seen, pretty good rejections there, but I've got a feeling the business isn't finished up there. So I was talking about that a little bit earlier before we had this move higher. We're starting to see that move higher play out as a result. That sort of idea of some unfinished business, a little bit of market structure to clean up. At the very least, you could tell this market really wants to go up there and try to give that a shot. On the other side of it, be careful with any size trading this. We are just about 18 minutes away from JOLTS and CB consumer confidence. Things are going to get way less liquid into that data and during it, and you could be on the right side of the trade and still get whipsawed out. So in an environment like this of lower liquidity, the way that I handle it, I'm way more careful about the trades I take and the setups I'm willing to take on. B, I reduce the size I'm going to use because C, I have to take wider stops. And the wider stops mean if I'm still using the same size, I'm taking higher risk. So the way I can reduce my risk if my stops are widening is to reduce my size, right? So it means I can still play in the market. I can still trade this tape, but I'm going to be way more careful. I'm going to size down because I have to use wider stops to accommodate for the volatility of an illiquid market. So I'm not looking at relative volume. I'm looking at liquidity. I'm looking at book depth. But relative volume is definitely light too, as you're showing. But check out CME Quick Strike. I think that's a really cool area to look at those historic book depth charts on any of the futures. So that would be CME Quick Strike would be a thing that I would check out if you're really interested in mapping this liquidity and the effects that it can have. It's free to use too. And it's got a lot of cool tools and fancy charts and other sorts of stuff in there. So definitely something to think about, that CME Quick Strike. And it's QUIK Strike. For some reason, they leave off the C. Don't ask me why. Okay, so Pippin asks, how do you see those stops on Bookmap? So that's part of the MBO data package. It's available through Bookmap data and Rhythmic data. And then you're going to want to set up your stops and icebergs, right? So let me go into an unfiltered view so I can show you how it works normally. So you've got your on-chart stops and icebergs and your below-chart stops and icebergs. Now, I've told you guys that I like to really focus on the bigger, more unusual flows. So I have it set up with a sample period of 90 minutes and a standard deviation of 10. Okay, so that's really only going to show the more pronounced icebergs. And the same thing for the stops. So we look at stops, 90 minutes, 10 standard deviation multiplier, and I'm also only showing stop runs. So if you have that data package and you're all set up with it, with the MBO data, you can add stops and icebergs. And I'd recommend using both. I think, having them both helps. The stops kind of show the more price sensitive short-term traders a lot of the time. Icebergs are the more, larger desks kind of passively trading this market. And it can be very interesting to see moments where they go against each other. For example, maybe you see a much larger stop run like this, where sellers are getting kicked out, and at the same time, you see icebergs layering in, selling thousands of contracts. That can give you the idea that you might be nearing a reversal, that cross current. You're welcome. Nightfox asks, any book suggestion which will help me understand the structure and nature of market movement, the context behind the movement for a NASDAQ scalp trader? Thanks for the reply in advance. I will say, for me, it was mostly exploration and learning that, like basically trading the futures and then becoming more sophisticated in how I built my systems and how I analyze flow. So it was mostly self-taught. So I don't really have like a one thing that I would point to, but I would say that there's a ton of great resources out there, more so on places like YouTube to look at market structure. And also there's a lot of academic papers out there, like white papers written by universities that have studied these concepts. So I would probably start with the videos for the super simple view. But if you've been trading this for a bit, I would probably then look at some of the academic white papers. And if you want, you can shoot me an email, mayhem@traderaid.com, mayhem@traderaid.com. Ask me that question so I can put together a response and cite some of those papers. It's harder to do live because I don't have them all at my fingertips, but I'd be more than happy to send you a bunch of educational resources when I'm offline. And I continue to review those, even though I'm mostly self-taught in that element of it. I've continued to review the academic work, especially because there's a lot of great insights in there about how things have evolved over time. For example, how much more the market is now moved by options than it ever used to be. This is one of those times where there's been an evolution. And there are folks that are sort of old guard that just really don't understand this stuff and don't want to look at it. And I get it. They have their systems. They say their systems work for them. That's cool. But then there's the folks that are looking at this flow and the impact that it has and building tools around it, myself included in that, with the SPX options visualizer you can see on screen now, mapping out that options volume that's coming in the S&P. I feel options are unavoidable. You have to really watch the flow. And the most optionable popular stocks, things like NVIDIA, Tesla, Palantir, Microsoft, but also in the futures market where you have the SPX index, an enormous area of options activity, and some of that hedging that happens for SPX index options occurs in the futures market. So there's a direct relationship between these two. And S&P options trade about 1.2 trillion of notional every day. Around half of that is 0 DTE. Around 75% in total are options that expire in about a trading week or less. So it's a lot more short-term focused. You got expiries every day, and you've got huge amounts of money moving through that options complex. So right now we can see, for example, more interest in calls. You do see some put flows, some at very low levels, so some of that's likely hedging. But you do see more interest in calls today than puts so far. That's one reason we've got that asterisk up by the hot call. That tells you the put-call ratio favors calls, and that's the most active strike on the chain right there. You can also see price challenging the call wall right now. And we're just about 11 minutes away from JOLTS and CB consumer confidence data, which could be interesting. If there is enough of a deviation, particularly in JOLTS, it could move this market. So we talked about it. I'm going to repeat as we approach the data. Forecast right now, 7.4 million. Consensus, 7.48 million. I'd look for 7.2 and below to be bullish and 7.6 and above to be bearish for that JOLTS data. You can see interest in calls continuing to build here. We talked about this scenario a little earlier. I'm going to just pull this back to my motive wave chart. We talked about this scenario earlier in the feed that it looked like there was this unfinished business that we had to clean up here. We are getting right back up to the call wall. Looks like the market's ready to kind of give us that decision perhaps around the time that this data comes out. Should be very interesting to watch. But so far, this is at least set up for an interesting sort of coming back to the scene of the crime trade. And there we go. We're getting a pop here. I don't see anything on the wires quite yet. And this is that 55.50. A lot of fives in that one. That's that pivot we talked about pre-market as well. I'd be looking for a pretty sizable continuation above there if we can make a decisive push and build acceptance, at least one 5-minute candle above building acceptance. Then I think we've got some room for some chunky continuation. Again, data dependent. I almost sound like the Fed saying that, but that's where we are right now. Let's go back to the Bookmap view. Liquidity improving modestly, 23,000 contract order book depth. Had a little bit of buyer exhaustion earlier. That's what this print means. Low confidence buyer exhaustion print, about 752 contracts associated with that event. And some iceberg selling around the same time. Nothing too big, but passive sellers really leaning in a little bit here. Iceberg's negative 1,300 showing you that. As we approach data, likely we see the order book start to thin out, particularly near price. But if we're looking at the flow here, quick update, you could see calls outpacing puts by more than 2 to 1. So again, lots more interest in upside based on the SPX options visualizer here. You can also see the call wall getting pulled higher. So all of this is looking pretty bullish in the option structure. Now the main event coming up that could change a lot of this is the data. But overall, based on the flow, everything I'm seeing so far is looking pretty constructive. Oh, just got some news that may have been related to this move. China waives tariffs on ethane imports from the U.S. So that's more sort of de-escalation news. And certainly that helps the spirits of folks that are looking for more signs that maybe, just maybe, there will be some progress made in the two most important trade partners involved in this trade war, the United States and China. Data just about 6 minutes away. Earlier today, we also had a cadre of earnings: UPS, General Motors, Pfizer, and PayPal. And this week, again, about 41% of S&P 500 market cap reporting. It's the biggest week in earnings season. Looking back at Q1, this is going to be the big week. And what's really interesting about this is once we get through a lot of these, the buyback blackout period is pretty much behind us because so much of the S&P 500 has reported, and so many of those companies are the bigger buyback authorization issuers and share buyback participants, that you start to see that supportive bid kind of coming back into the market. So later this week and into next week, that buyback bid looms large and should be constructive. That's one of the largest sources of flows into stocks in this market is share buybacks. And we can see we're just sort of consolidating here. May have had a bit of an Icarus moment there ahead of data, getting that excited. So we're just going to pull this back to the motive wave view. You can see once again, knocked on that 55.50 pivot, but we couldn't build the acceptance up there I was talking about. I'd really love to see a 5-minute candle trading above that pivot to tell me, we're probably out of the woods on this down move and we've got some room higher. Add to it, we've got data, we've got some hedging flows coming in ahead of that data. So I think that right now, the biggest risk here is that data comes in hotter than expected and we retrace this whole move and even start to move lower than that. On the other side, if this data comes in better, and better is worse and worse is better, we're in the upside down. So 7.2 million and below on JOLTS, probably bullish. 7.6 million and above, probably bearish. Hate to say it, but more jobs on offer keeps the Fed on hold. The Fed being on hold makes it more likely that you don't get the liquidity the market really wants to see. It's all kind of interrelated. So the market's more addicted to liquidity than really wanting to see constructive economic outcomes. That's kind of the world we live in right now. And we see price getting back up to that 55.50 pivot ahead of data, just about 3 minutes away here. So we're going to go back into the bookmap view, but just keep this chart in mind. This pivot at 55.50 is a key level to watch here. And it's not too far from that day's high. And you still see that call flow really building. The warm call and hot call now 10,000 transacting there versus 5,000 for the hot put and warm put. So these are the two most active strikes on either side of the chain. And it's just telling you there's a lot more interest in higher prices than lower prices. Do see a sizable bid coming back here at 5,500, 193, and then you've got these offers up above around 55.85, 222, and 5,600, 260. And we'll move into the filtered view here as we approach the data. You can see those bids and offers a little more clearly. Data in less than 2 minutes, JOLTS and CB consumer confidence. One minute. You can see the order book thinning out here. See how that heat map was, pretty much lit up, and now it's starting to go dark. This is why it's real risky to trade these events, folks, because the sort of market making that you would hope would be a buffer just does not exist. And as a result, you can have price move a lot more in a much choppier pattern that can stop people out on either side of the trade. So be careful trading through these event volatility catalysts. You usually get an exaggerated move on any deviation in the data. 20 seconds. 10 seconds. That is imminent. JOLTS coming in at 7.192 million, 7.192 million versus a forecast of 7.5 million. US CB consumer confidence coming in at 86. So far, seeing a bit of an initial pull, and then that being bought back, some kind of mild stop run to the downside there, 342 contracts, nothing too exhaustive. JOLTS did come in below 7.2, which you would think would be somewhat constructive for equities, but consumer confidence was also shockingly low. 86 is a very nasty print on consumer confidence. So I think that might have spooked people just a little bit. I think we got what we wanted with JOLTS. We do want to see those offers come down a bit. We do want to see some signs of slowing, so the Fed's willing to be more accommodative. On the other side, however, consumer confidence, especially from Conference Board, which is a pretty nice survey in terms of its objectivity, it deteriorating that much suggests that you're going to have less consumer participation in the economy, which then suggests you could have an impact that is seen in earnings and econometrics. So I think that print, that deviation is what got us that little bit of a head fake lower. You could see now, though, we're getting bid back. And this is my thought. I think that the good outweighs the bad in this data overall. We can kind of all look back at sentiment surveys and know consumers aren't happy right now, and they're probably not going to be happy for a little while. I think the market tried to discount that as much as it could in some of the volatility we saw earlier this month. On the other side, however, seeing JOLTS come down, that's a little bit more like forward looking. If you look at the survey, that's done. That's where people were. JOLTS is jobs that are on offer now. So I think that overall, the good outweighs the bad. We'll let the market tell the tale of the tape to us as we go. But I'd be looking for, once again, if we can build acceptance above this 55.50 pivot, I think we can get up to this major pivot. The next level is 55.72.50. That's the major pivot. And then above there, we've got some of these levels to watch where the options flows are targeting, right? The hot call and the warm call specifically still outpacing the puts pretty significantly. So this is still a market that wants to move higher. So mixed bag in the data, CB consumer confidence coming in much worse than expected. And here's why. Average 12-month inflation expectations reached a shocking 7% in April. The highest since November of 2022, when the U.S. was experiencing extremely high inflation. So obviously consumers are very worried about inflation given this print. That's, I think, where some of the shock came in. But again, this is a bit backward looking, and it's not very surprising given all the other consumer data we've had leading up to this point. From UOM, for example, saying very similar things. In that survey, it was the highest outlook for, I want to say, inflation since 1981 or something like that, which was a little bit extreme, obviously. This survey seems a little more grounded, but it still gives us that same sense. Consumers are worried about prices here. So overall, looking for that pivot to be broken above, and then I think we've got room higher. So I'm going to close out by just giving us a quick refresh on what we've got on screen here. So the 55.50 pivot, I'd like to see a break above with a 5-minute candle that holds above it to show we're building acceptance. And then I think we can start to go to that major pivot, and above there, we can start to hit some of these levels where the options are trading. If we get rejected there, we could get right back to today's lows. So you've got 55.30 as a pivot level to watch, and then below that, 55.23.50 as a gamma 1. That correlates to S&P 5500 on the cash index. The market looks like it wants higher. The call structure versus the puts looks like it wants higher in the flow. There's just a lot of things overall that are telling us this thing kind of has some momentum behind it to move higher and reverse some of that overnight move. That's what I'm seeing in the tape right now. I hope you enjoyed this episode of... Sorry, folks, got something in my throat there when I was speaking. It's the allergy season coming up, so that's starting to catch up. Hope you all enjoyed this episode of Back to the Futures with me, Markets and Mayhem. Again, if you'd like to check out Bookmap, you can get up to 40% off visiting TraderAid.com/bookmap. Scroll down to the specials. That's at TraderAid.com/bookmap. And if you'd like to check out what we're doing, visit TraderAid.com. Learn more about our tools like the SPX Options Visualizer. You can plug this into your own copy of Bookmap or MotiveWave. And check out our Discord. We've got a lot of these tools, great ideas, and an amazing community. You can get up to 20% off using the code Mayhem20 at checkout at TraderAid.com. Thank you, everyone, for tuning in. Appreciate you all a great deal. You can see that push starting to happen right now here. Look at that. 244 more shorts stopped out here. Market wants to push above my pivot. This is looking like a move that's going to continue higher. So good luck, everyone, trading today. Appreciate you all. See you next week, 9 a.m. Eastern. I'll also be around for the mega cap earnings if you want to live stream those with me. I'll be watching the price action after the release and the conference calls for the mega caps. Talk to y'all later. Have a great week.